Good day, traders. This is Mike once again for Lazy Trader Mike's YouTube channel. Today we're going to discuss about margin and leverage. As I noticed, there has been some confusion as to what margin is and what is a leverage all about. Most people that are confused are, of course, that are fairly new to the forex market. Now we will clear out that confusion. Alright, when you first visit a broker website, let's say you have $10. Let's say like right now, Traders Way is promoting their ECN account for $10. So $10, yeah, I can trade $10, but how much leverage is required for a $10 account to meet the minimum trade size? Now, when you first visit a broker website, you always look for trading conditions. Now, whatever broker website that is, it will always be available. Now, on Traders Way, there are various accounts. So let's just check this MT4ECN, and it's actually the one I'm using right now. So on MT4ECN account, you just need to look for this part: minimum volume of a transaction. Alright, it reads there 0.01 of a lot, 1000 units of base currency. Do not confuse yourself. What is 1000 units of a base currency? Just treat that as 1000 units or 1000 contracts, and 0.01 that will show up on MetaTrader as this volume. That is the 0.01 being shown as the minimum volume of a transaction. So when you place an order, it's already fixed. You cannot edit this one below 0.01. You're not gonna be able to trade. Let's try that, okay? Since this is a demo account, let's say I try to place an order for 0.001. You're not gonna be able to execute that. But if you change that to 0.01, you are going to be able to trade. So that's gonna be how it will be reflected on the MetaTrader. So let's go back to this. Now you have a $10 account. You intend to deposit, try out Traders Way promotion for $10. But how much leverage do you think you need to meet this minimum volume of a transaction? So I prepared an Excel sheet here, some Excel sheet. So the broker requirement is 1000 units. You only intend to deposit $10. Now the easiest way for you to compute the leverage required or amount that you need is this: you just divide the minimum lot size required by the broker to your intended deposit amount. So that would be 1000 over 10, or 1000 divided by 10. So that will give you 1:100 leverage. Leverage is actually the amount of money being shed out by the broker for you to execute a chosen trade and meet the minimum trade size for that trade. While margin, do not confuse yourself what margin is. Margin is technically your account balance. So if you look at the terminal here, if you see your balance here 150.21, that's gonna be the same with your equity, and that's gonna be the same with your free margin. Margin is just some fancy name to name something on the forex market, but technically that is your account balance. So once again, leverage, the broker will virtually multiply your $10 times 100, and then so you can control 1000 units of a trade or of a currency. So if you use like 1000 leverage let's say you wanted to use 1000 leverage here, you can do so as well. There's no problem. If you use 1000 leverage, you can just multiply 10 by 1000. It gives you 10,000 units of currency to control. But where does margin comes into play? Now when you put in a trade, let's say you found a trade on Euro GBP, and the trade entry is or the trade is a sell short or a short. So sell short, that's gonna be redundant, sorry. You like to short 1,000 contracts at 78825, and your stop is 79970. So the difference from your entry to your stop is 1,145 points, or 114.5 pips. So if you multiply 1145 times 0.01, you will get the dollar value of your trade risk or your stop loss, which is $11.45. There is already a problem with this trade because there's no problem with leverage. Your leverage, let's say this is your account size, $10, and you leverage that with 1:1000 leverage. Now, yes, you can control 10,000 units of currency here, but your margin is not enough to cover the stop loss. So this trade is good for leverage. It's okay for the leverage, but the margin is not enough, so you're not gonna be able to place the trade. All right, so let's look for, so you want to trade this Euro GBP. Let's say you found a good setup on the daily chart. So this is the one. So for you to be able to compute the risk amount quickly, not need to look for profit and loss calculator, you can just pull up the crosshair, or you click on Control F on your MetaTrader. So then you point that to the price where you desire to enter the market, and then you click and hold, or press and hold left mouse button, and you drag it all the way to the point where you want to put your stop. So the middle number there, 1138, that's the point difference from your entry to your stop. So multiplying that by the volume that you want to trade this, 1138 or 1138 times 0.01 will give you $11.38 of risk. And you can just try to check if that would be a good trade based on risk reward. So that's gonna be a potential profit of $15.42 for a 1,000 unit contract. So typically you're risking $11 or so to get $15, which is not actually a good risk reward ratio. Now so you wanted really to trade this, but your margin is not enough. Although the leverage can handle the trade, but your margin is not enough. So you switch to an intraday chart, because you know that people might sell because of this signal, and this is a zone as well. So you check on the intraday, see if there's a follow through on the next day. Once again, this is hindsight analysis. This is just for the sake of example, so don't take this as it is. Alright, so you try to look for an intraday trade on the next day. Let's say you found this engulfing candle here, and you once again you pull up the crosshair, and you place that to the price that you desire to enter, and then you press and hold left mouse button, and you drag it to the point where you would want your stop loss to be. So that's gonna be the third number there on the crosshair would be the price. The first number would be the number of candles being measured. So you just need to pay attention technically to the second and third numbers. So 421. So that's gonna be if you multiply that by 1,000 units or 0.01, you will get roughly point. Alright, let's say a 427. You multiply that 427 by 0.01, that's gonna be $4.27 of risk. So if you would trade the daily signal on the 1 hour chart and you were able to find a good setup and you trade that, that's gonna be good for your margin and good for your leverage as well. So you meet all the requirements and that is a good to go. So you are risking roughly $4.24. See if your trade comes down to this point, let's say $9.68. That's a good for a 1-to-1 risk to reward ratio. So that's gonna be it. That's just basic margins and margin and leverage tutorial, so you don't get confused. Once again, leverage, that's the virtual amount of money. They technically would just multiply the amount of money that you deposit, and margin, that is your cash balance. Not because your leverage is really high you are able to max out the leverage. You're not going to be able to max out the leverage unless your margin is able to support the stop loss or the risk required for that trade. That is a sort of collateral. Alright, so once again, keep it here on Lazy Trader Mike's channel. Check out my broker as well, Trader's Way. They're great. They use bitcoins for deposit and withdrawal. It's fast, it's cheap, and they are reliable as well. Alright, so check them out. Their link is on the description box below. Until next time, once again, this has been Mike, and you have a great day.